Hey everyone, welcome back to your Money Your Life podcast. We're on episode 311 of the pod. Before we get into it, make sure you like, subscribe, 5-star rating review. Also share this podcast with a family member or friend. We're the third episode of the year. Hope your new year has started great so far. For me, I'm focusing on like systems versus just like you have your end goal, but then you have really you're just like, oh, I'm going to work hard to get to these things. But like the systems you put in place, the everyday habitual systems, even if something that's pretty habit based, but putting efficient systems in place has been really helpful and is going to be really helpful this year. What are you doing? What are you going to do to really knock out 2026? Let me know in the comments. We're going to jump right into it. And first and foremost, we are going to look at our chart, which is giving us what is happening over the past week. The past week of the market has been roughly flat. Now, we have different things playing right now in the market. Of course, you have bank earnings that will go over some of those bank earnings. You also have geopolitical stuff that's going on and other ramifications of the economy. Inflation, still a theme. Will the Fed cut rates? How many rates? All those things are still happening. But the market just said, hey, none of it really matters yet. We don't know which way to go. So the past week was flat. Year to date, we're up a little bit. The market started up a little bit. We're up 0.68% so far from the beginning of the year. Past year, we know has been really, really incredible for the market. And, look at the past 5 years, honestly, just keep investing, stop, second guessing long term compounding interest. That's the main theme of that. Let's go into bank earnings. What is happening? So, Goldman Sachs, they topped their profit estimates. Equities, assets, and wealth management outperformed. So they said, hey, we invested well. Our asset management well, so the investing that we did for our clients and everyone else and grew as well. And that was pretty much the let's look at the Goldman Sachs. They beat estimates. Their profit jumped 12% from the year prior. Their revenues dipped slightly. So the revenue dipped slightly. Let's dig into what they really liked on the quarter. They sold the Apple Card business. Um, the revenue dipped, as we just said. Despite the revenue hit from the offloading of its credit card business, the firm's Wall Street-centric model is thriving in the current environment. High stock prices, falling interest rates, rising engagement from institutional investors. So their institutional high, ultra high net worth is all they deal with. Investors continue to pour cash into the market. They're seeing high levels of client engagement across their franchise, and they expect momentum to accelerate in 2026. Um, Their biggest source of outperformance in the quarter was from equities franchise. Equities trading revenue jumped 25%. Fixed income climbed 12%. Investment banking fees jumped 25%. Interesting. Matching the street account estimate fueled by gains in mergers and advisory and debt underwriting. That's a positive sign for them. Their asset management business. Oh, wait, let's see. Revenue was unchanged early from their year earlier at 4.72 billion, though that exceeded the street account estimate by about 270 million. So measure grew barely, but it still grew. So that's a deep dive into their earnings. They're pretty much giving a bellwether of like what's going on. What are ultra high net worth doing? What is just in general? How is money flowing in the bank? Investment banking fees were up. They're seeing activity. That's just the benefit of a strong 2025, to be honest. And what we saw in 2025. If you look at what's going on, you do see the market again, depending on when you listen to today's episode, up slightly. There might be some new tariffs imposed on semiconductors said by the administration. Morgan Stanley also came out with their expectations and their quarter results, and they exceeded expectations. So their stock rose a little bit in pre-market trading. Goldman Sachs, even though we just gave them glowing reviews, or we had read the report, which had glowing data on it, they dipped slightly in trading. Oil prices, we could talk a lot about oil, but the oil prices have pulled back slightly. And so the latest economic data that we want to point out is jobless claims. Jobless claims for the week ending January 10th came in at 198,000. That's lower than the 215,000 expected by economists polled by Dow Jones. So that's another thing that the theme that we're watching is, employment. Is that unemployment rates going to rise? Is it going to stay steady? That's a huge, huge factor to understand. Uh, so that's huge. And then also inflation, the theme on inflation. So keeping your eyes on those things are, heavily crucial for 2026. Let's look at what BlackRock is doing. BlackRock, as you should know, is the big financial firm. They surged to record 14 trillion in assets, so they manage 14 trillion. BlackRock kept taking in cash in the fourth quarter as assets topped 14 trillion for the first time. The world's largest money manager took 342 billion in client cash, pushing its yearly haul to a record 698 billion. Exchange traded funds drove 181 billion of that growth and are now worth 5.5 trillion. Expenses rose, however, leading to a 33% drop in net income. So again, they're taking in so much cash. A lot of people were piling in cash in 2025 because they saw inflation up, assets up. They saw kind of play there, and so you're seeing a lot of people throwing money into the market, and that's the results that are coming out of 2025. So they hit 14 trillion in assets under management, which is a lot of assets under management, and they have different plays, real estate, equities, ETFs, a lot of different things than what you may think. Let's go to some other opposite end of the news. Saks, Saks Fifth Avenue and Saks itself. So major player in the high fashion retail game. They're filing for bankruptcy. And Amazon seems to not like it. In newly filed court documents, Amazon claims a luxury retailer violated the terms of a deal to sell Saks products on its website, leaving the e-commerce giant's investment presumably worthless. Amazon took a minority stake in Saks in 2024 as part of a push to help the upscale department store chain rival Neiman Marcus. At that time, Saks committed to paying Amazon at least 900 million over 8 years. So they had a deal. To Amazon came in to help them rival Neiman Marcus and to influx with cash. And then that still wasn't enough to save Saks. They're filing for bankruptcy. For those that don't know, if you go onto their website, you probably see some pretty good deals there now, just because they're going to file for bankruptcy. So Saks got the green light for 400 million in emergency bankruptcy and financing, and plans to use that to keep stores open, pay 17,000 in staff, and restock after months of inventory chaos. But we'll see, how that goes. But yeah, make sure you get the deals if you are in the market for, something to buy. OpenAI just inked a deal with AI chipmaker. OpenAI has linked a 3-year deal with a startup, Cerebras Systems, to purchase an additional computing capacity to help fuel the ChatGPT maker's next growth phase. The agreement could be worth an estimated 10 billion, may add as much as 750 megawatts of computing power. Yeah, I guess the thing, if you're still using, again, all the different AI chat boxes, I'm still using Gemini, of course, and ChatGPT. I want to dip back into Cloud again. I'm sure it got better since I last used it. But the big thing about them is I think ChatGPT is slow. Like Gemini is really, really fast for me. Gemini is fast, it moves fast, may not give the answers as well as sometimes as I wanted that ChatGPT does, but it's just faster and the answers are getting much better. ChatGPT needs to increase the speed if they want to compete. I think it's very clear to me. Gemini is really, really coming up the ranks and maybe in the lead for most people. I just have a lot of data still in ChatGPT as far as questions I've asked. So it's a really, really good race that's going on. Here's another story I saw. New York knocks Uber, DoorDash over tips. So Uber and DoorDash delivery workers in New York City have lost out on more than 550 million in tips, and this is thanks to changes to both companies' app interfaces. According to the city's Department of Consumer and Worker Protection, per the agency's report, the company moved tip prompts on their apps to appear after checking out, following the implementation of new pay standards in late 2023, with average tips amount seeing steep drops within a week. No DoorDash person called the report flat out wrong. So that's interesting. So I do remember this change. I remember there was a whole hoopla back then of the change, and then they were saying, there'll be some once in a while a delivery person would say that they don't even get the tips at all, which I know that shouldn't be true, I would hope. But yeah, they did change it. I don't know how that affects I always tip, and it's just a given, right? I know other people don't, some people don't, but tip people goes a long way and it doesn't affect you. I would say that that's a big, a big easy thing for everyone to do. Make sure you tip and tip appropriately. Let's go to the roundtable this week. The roundtable this week, we're going to talk a little bit about buying your primary home, And you've probably seen or heard people talk about that. Oh, I'm going to buy my home via an LLC. And they claim there's some tax advantages or some other benefits. There's not. And we, did a deep dive. And of course, for myself as a homeowner and other homeowners out there, you probably know that that's false, right? Let's look at the deep dive on why it is false. Let's take at taxes first. So taxes, there is something called a capital gains exclusion. So under the IRS code, it's section 121. If you sell your primary home, the first 250,000 of profit is tax free. And if you're married and file jointly, that's $500,000 in profit of your selling of your home. The first portion of that, that is tax free. Then after that, it's capital gains tax, no matter how you look at it. Um, if an LLC owns the home, though, in that scenario that I just mentioned, you may lose that exclusion entirely, meaning you'll pay capital gains tax on every dollar of profit when you sell. If you buy via an LLC versus natural person, your own name, many states have homestead laws that lower your property taxes and protect your home's equity from being seized if you're sued. Most states only grant this to natural persons. If a company, meaning the LLC, owns the house, your property taxes could be significantly higher and your equity is more vulnerable. So yeah, there's like really no real advantages unless someone has something they can point out. The only one we really saw through research is privacy. If you're a high profile individual or celebrity, you don't want your home or address searchable via your name. An LLC keeps your name off the court public deeds of records. So that's about it. Privacy or potentially really high net worth and doing something different. But other than that, we did not find much of these large, these non-transparent advantages that people love to spout about. So if you do find them, let me know. Folks, this is the third episode this week. Excuse me, third episode this year. Ramping it up again, doing more content, doing different things. Share this with your family and friends, and we will talk to you next week.